Investment. Have you seen the headlines today? The August CPI data is out. And if you just glance at the top numbers, you might think, great, inflation is slowing down. But here's the thing. There's a lot that's not being highlighted. The consumer price index isn't just a number. It's a window into how your money behaves in the real world. When inflation rises, it's not just about the cost of a coffee or a gallon of gas. It's about your entire financial ecosystem being subtly shifted, and most people don't realize it until it hits their wallets. Now, investment. Break it down. The CPI report shows that inflation is easing slightly, but that headline number masks some important trends. Energy costs are dropping, which is why the overall inflation figure looks better. But essentials like food and housing are still rising steadily. That means while your gas bill might be a little lighter, your grocery cart could still cost more than last month. For most Americans, investment, this is where the pinch is felt, and this is what mainstream media often glosses over. Understanding this gives you an edge. It helps you plan your budget more effectively instead of being blindsided. But it's not just about day-to-day expenses. This data has ripple effects across the economy. When inflation is sticky, the Federal Reserve may respond by adjusting interest rates. That directly impacts mortgages to loans and even returns on investments like bonds. Savvy investors are paying attention to these trends because a few points in inflation can make a huge difference in wealth building strategies. Stocks react, bonds react, and your personal savings strategy should too. Ignoring it means leaving money on the table and being unprepared for changes that could influence your financial future. So what can you do? Investment. Start by looking at your budget through a sharper lens. Track exactly where your money is going and be ready to cut or reallocate where inflation is hitting hardest. Consider protecting savings with instruments that outpace inflation and adjust your investments to hedge against these shifts. The key is to act with intention rather than reacting out of panic. This isn't about fear, it's about control. When you understand the story behind the numbers, you can make smarter financial decisions and even leverage this knowledge to your advantage. The August CPI data is more than just numbers on a page. It's a signal. It's telling you where your money has the most friction, where to adapt, and how to anticipate what's coming next in the financial world. Most people will scroll past it, shrug, and move on. But those who take a deeper look, who see the implications for their budget, investments, and long-term planning are the ones who win. So don't just read the headlines. Dive into the numbers, understand the trends, and use this knowledge to make your money work harder for you. The August Consumer Price Index report is out, and it's easy to get caught up in the big headline numbers. Most people see a single percentage and immediately form an opinion on inflation is rising, inflation is falling, or maybe it's under control. But the CPI is more than just a number. It's a reflection of how prices are changing across hundreds of goods and services that make up your everyday life. It measures everything from groceries and gas to housing and healthcare. Understanding the nuances behind these numbers is crucial because the headline figure can sometimes be misleading. For example, the energy costs can swing month to month, and a drop in gas prices might make overall inflation appear better than it actually is for your wallet. Meanwhile, essentials like food or rent could still be climbing steadily, quietly eating into your purchasing power. By breaking down the CPI into its core components, you can see where the real pressures are. This is important because it informs decisions about spending, saving, and investing. Knowing which parts of the economy are driving inflation helps you to anticipate changes, adjust your budget, and protect your financial position rather than blindly reacting to a single statistic that doesn't tell the whole story. Inflation isn't just an abstract economic term. It directly affects your day-to-day life in ways most people don't immediately notice. When the CPI rises, even modestly, it changes the cost of the things you buy every single day. Groceries, gas, rent, and utility bills all start creeping higher. And before you know it, your paycheck doesn't stretch as far as it used to. What's tricky is that these shifts aren't always obvious right away. A small increase in food prices might seem insignificant in isolation, but over weeks and months, it compounds investment, quietly eating into your disposable income. Similarly, rent and housing costs often rise steadily. And if you're not tracking these changes, you could be overpaying without even realizing it. Even discretionary spending, dining out, streaming services, or hobbies get squeezed because the essentials take a bigger chunk of your budget. Understanding these subtle impacts gives you an advantage. You can plan smarter, prioritize your spending, and avoid financial surprises. Instead of reacting when prices have already gone up, you can anticipate trends, adjust your shopping habits, or look for ways to offset these increases. Being aware of how inflation affects your wallet daily isn't just smart. It's necessary for maintaining financial stability in a world where costs are always changing. The CPI data isn't just about everyday expenses. It has major implications for your investments and overall financial strategy. When inflation shows signs of slowing or accelerating investment, it directly influences how the stock market, bond market, and interest rates behave. For instance, if inflation is higher than expected, the Federal Reserve may raise interest rates to cool the economy. That can impact everything from mortgage rates to the cost of borrowing for businesses, which in turn affects stock prices. Bonds are also sensitive to inflation. Rising inflation erodes their real returns, but making them less attractive to investors. On the other hand, certain sectors in the stock market, like consumer staples or energy, may benefit during periods of high inflation, while growth stocks can struggle because higher interest rates reduce future earnings value. Understanding these connections allows you to make smarter decisions rather than reacting emotionally to market fluctuations. By keeping an eye on CPI trends, you can adjust your portfolio, balance risk, and even explore opportunities in inflation-protected assets like types or commodities. Essentially, this data is a roadmap investment. It tells you where the economy is heading and how your investments might be impacted, giving you the power to act strategically instead of being caught off guard by sudden market moves. Knowing the CPI data is one thing, but taking action based on it is what really protects and grows your money. The first step is revisiting your budget. Track exactly where your dollars are going and identify areas where inflation is hitting hardest, maybe groceries, gas, or housing, and adjust accordingly. Small changes, investment, like finding cost-effective alternatives or cutting non-essential spending, can add up significantly over time. Next, think about your savings. Cash sitting idle loses value when inflation is rising, so consider options that offer returns above inflation, like high-yield savings accounts, short-term bonds, or even certain investment accounts. For investments, diversification becomes even more critical. Stocks, real estate, and commodities can all react differently to inflation, so spreading your money across asset classes helps reduce risk and capture potential gains. Finally, keep a long-term perspective. Short-term inflation spikes are inevitable, but by planning ahead, you can avoid panic decisions and stay on track toward your financial goals. The key takeaway is simple: don't just watch the numbers, use them. Every CPI report is a chance to recalibrate, protect your purchasing power, and position yourself to take advantage of economic trends rather than being at their mercy.